everyone from wherever you're joining us in the world. Welcome. My name is Mark Muller. I'm Director of Sanlam Private Wealth in Mauritius. For those of you who have attended our webinars before, you'll be no stranger to Phil, having joined us all the way from the UK. And this morning, we're very pleased to be welcoming as well Alwyn van der Merwe. I'm going to read their CVs to you very quickly, but before we do so, I just want to touch on some housekeeping issues. Phil and Alwyn are going to present for about 20 minutes or so, and then we're going to open the floor up to questions. We hope to wrap up in 30 minutes, so we keep it nice and punchy. Please email me or either email me or post your questions on the chat. We did receive during the course of yesterday a whole ream of questions, and we'll try to get through as many of those as we can. The questions that we cannot get to, we will be getting back to you, or you can email us directly, and we'll respond. I'll flick them on to Alwyn and Phil. So without any further ado, let me introduce our esteemed panelists this morning as Alwyn gets ready for the session. Alwyn van der Merwe obtained his BCom and MBA degrees from the University of Stellenbosch in South Africa. Alwyn was appointed as Director of Investments for Sanlam Private Wealth in 2007. He has over 24 years investment industry experience and managed institutional and unit trust portfolio success for 14 years. Alwyn leads and chairs Sanlam Private Wealth's formal investment committee as well. Then Phil is joining us from the UK this morning. Welcome, Phil. Phil joined Sanlam in 2014. Phil graduated with a first-class honours degree in mathematics from Oxford University and began his career in 2000 with the European equity team at Tokyo Mitsubishi Asset Management. In 2006, Phil joined the global equity team at Battery March, where he has a track record of running a market-neutral hedge fund as well as global equity long funds. Phil has been a CFA charter holder since 2003. So with that introduction, I feel like I need a break and a breath of fresh air. Good morning, Alwyn. Good morning, Phil. How are you this morning?
Good. So after hearing that sort of litany of achievements there, I'm feeling quite old. It's definitely a lot of time that's passed since I started an investment business, but not as much time as Alwyn.
Good morning, everybody. Good morning, Mark. I'm afraid to say there's one thing wrong in the stats. It's not 24 years. I think that is when I joined. So it's now 30 years. So if I look old, I am old. But not tired.
Thank you for joining us this morning, gentlemen. What we're going to be running through, as the name suggests, we're going to be looking forward to 2022 and what to expect. Obviously, looking into a crystal ball, quite subjective, but I think between the two of you, we have a good handle on what to expect. I'm going to start this morning. Trends for 2022, we've in our discussion we've boiled those down to three, that being inflation, monetary policy, and the end of a multi-decade bull bond market. Inflation, is it transitory, and how do equity markets react to inflation? So, Phil, if you can enlighten us on your expectations on inflation going into 2022.
Sure, yeah. Thinking that there's a good hour's worth of content in that question. It's quite a complicated area. But if we just look at it, inflation, we've seen that inflation has increased throughout this year. And a large part of that is the payback from the assistance that governments and central banks have given the economy the previous year. If you look at what's happened, we've seen GDP recover. And we've seen a huge amount of money being created to soothe the ills of the pandemic. And that money is out there, it's in the system, and it's sloshing around. And what we've seen is that people have been taking that money, have been trying to buy stuff. And if you look at the US GDP, the most startling thing that comes out of it for me is the surge in the contribution of retail sales on goods. And a lot of those goods have to be shipped and imported. And it's phenomenal, really. So ordinarily, people will buy more stuff every year. okay, and that grows slowly year after year. But what we've seen this year is we've had effectively 6 years worth of growth in the stuff that people are buying, and the economy just can't cope. So the economy is trying to deliver 6 years worth of growth in production of goods, and it's trying to put those on container ships. It's trying to produce the energy to transport those around and package them up and deliver them to the end place. And the reality is it just can't. We've created a lot of purchasing power and a lot of excess demand, and the productive capacity that the world has just really can't cope with that. So we're starting to see shortages as a consequence of the inflation that we've created, and those shortages are persisting quite widely. And what's the solution to shortages? Well, we need to ration out what the productive capacity we've got, and we're doing that through prices. So that's why we're seeing prices go up. We're trying to buy more stuff that can we actually create. It's been a trend that's been in place this year. I expect it to continue into next year, because the fundamental problem won't be solved. We can't just build 6 years worth of extra ships, extra ports, extra energy capacity, and extra factories. And of course, now it's compounded by the fact that if you're trying to create extra supply, there's competition. So think about that semiconductor shortage. Okay, we've got a lot of people saying, I want a new iPad, I want a new computer. They're demanding semiconductors. And then there are other people saying, okay, we need to increase our factories, so we need robots. And the economy has to make a decision. Does it ration those semiconductors into building new productive capacity, building new robots in factories, or in consumer goods? So really we need to see the consumer sort of step back and have less production and start having more savings, and those savings can then go into productive capacity that will solve the supply bottlenecks. I think the most interesting chart for me, I've only got one chart today. I haven't brought a huge slide deck, but I will share this one. Yes. So consumer price inflation is probably the most common measure of inflation that people are aware of. And of course, that is right the way at the end of the chain. So inflation, first of all, you create new money, then you hand that money out, and then that money chases goods, and then producers try and produce those goods. And then the consumer is really the last person in the chain that sees how the inflation sort of moved through the economy in these waves. But one step further back up is what's called producer price inflation. And that is the inflation that companies are seeing as they try and create goods in order to ship them to the final destination, a consumer. And that's the blue line. So whilst we've focused a lot on the orange line here, consumer price inflation, producer price inflation is even higher. And actually, I've put two arrows on here. It's back at the same level that we had in the 1970s. And that for me is pretty amazing. And it shows the pressure on companies at the moment. That's why you hear all of these companies as they report saying things like, we've got cost pressures, packaging's gone up, freight's gone up, soybeans have gone up, oil's gone up. Everything that they use to produce whatever they produce has gone up in price. And they're seeing that in a very acute way in their business. And how are they responding? Well, they're putting up prices as well. So even today, just looking at Unilever's reports, it's putting up pricing, and it intends to accelerate that. Businesses around the world are having to push these prices through to the end consumer, even though their volumes are hurting. So normally you'd be hesitant. You would say, I don't want to put up price, because what if consumers no longer buy my goods because it's too expensive? Well, here they have no choice. They either put prices up or lose money. And the reality is consumers are still going to buy their goods because there are shortages. If your good is the only good on the shelf, then people are going to buy it. So to me, we've seen a similar dynamic as we've seen in the 1970s. And I think it's very sensible to expect that producer price inflation to at least continue next year and continue to flow through to consumer price inflation. Of course, where we go from there is a political choice. We can either continue to do the same policies and stimulate the economy, or we can step back. We can let interest rates rise so consumers say, oh, maybe I shouldn't spend as much, maybe I should save a bit more and give it to a company that's going to build out productive capacity. So I think inflation is going to remain high next year, and CPI is probably going to rise a little bit more in the US.
Well, how does that on monetary policy side? What's the effect going to be? Do you think from central banks? What's the reaction? You mentioned raising the rates. Where do you think that's going to go? Starting with developed markets and the effect that their reaction will have on emerging markets such as ours.
Yeah, so we're moving in that direction, but reluctantly, and I think that's the thing to understand. The Federal Reserve looks set to taper its quantitative easing process. A lot of jargon in there, but what does that mean? It means that it's going to buy less bonds month after month. So at the moment, it creates new money, it purchases bonds in the market and takes those onto its balance sheet in exchange for cash going out there. So it's indicated that it's likely to start that process in November. We've got places like the Bank of England, which are saying that they might have to raise rates a couple of times, possibly next year, indicating that's the expectation in markets. So markets are thinking that 1 or 2 rate hikes might come, but it's going to be fairly slow. The reality is we're at 0 and inflation is at 5%. So with negative real rates of 5%, I'm not sure that 1 or 2 inflation hikes are going to be enough. I guess in their favor, what the central banks have in their favor is that there's so much debt around now that the sensitivity to interest rates is probably a lot higher because of the magnitude of the debt that's outstanding. So that might mean, if you think about it as a car with the interest rates being the brakes, those brakes are a lot more sensitive than they would normally be, and just a small tap on the brakes could do the trick. But central banks will be a bit fearful because they don't want to skid the car.
Well, how do equity markets react to stagflation? Sorry, Alvin, after you.
Sorry, may I just add 1 or 2 things? And if you don't mind, Phil just mentioned, US inflation just about 5%, it's 5.4% on the dot. But it's very interesting to just see what the market is saying. In the interest rate markets, there's an expectation how the Fed would respond. And it's Phil, I thought this morning, that has changed, and the money market in the US reckons that interest rates can go up by 1.75% next year. Now that is way too aggressive, given our view. And there's the Fed members, they also put their forecast forward for interest rate hikes next year, and it's certainly not 1.75. I think that is too high. But if I may say one thing about inflation, it's not. We certainly don't say 10% or double-digit inflation, because that was the case back in the 70s that Phil referred to that. But if I may just share my screen, and I want to show one inflation chart, and it touches on what Phil has said. I think it is not, inflation is not about everything. And there were 2 major reasons. If you unpack the CPI inflation index, the one is used cars. Used cars year-on-year inflation was 24.4%, which simply means that used car prices went up by 24.4%. And the other one, and that is the one, Phil, where I agree with you, that for me is a risk, is the high energy prices. That is up by 25% year-on-year, and there might be second-round effects like you explained. But if you look at the rest, I think one must be very cautious not to get overly excited by this, because we can already see that in certain cases, semiconductors, it's coming out of Taiwan at the moment, and you can see that the lead times are starting to come off as well. And then the final thing, and Phil mentioned about the political decision. On the one hand, you need to address inflation. But on the other hand, you don't want to derail economic activity too much. And I suppose the risk is, at the moment, the way I read the Fed is that they are more conservative. In other words, they would not like to derail economic activity. And the risk to that is, if they stay out of the mode of hiking interest rates and address the inflation rate, at some point the hand will be forced and then they need to overreact. That for me would be a bigger risk to the markets, Mark.
The effect will be, Alvin, just following from what you and Phil have spoken about on equity markets and the potential reaction to stagflation that may be coming.
No, I'm still not in the stagflation mode. Phil gave a definition of what is stagflation. That is when the inflation rate is higher than the growth rate. And if you look at the growth rates that we've got forecasted for next year, you know, to my mind, if I can just give you this slide, you know, you can clearly see that for the world in 2021, our official forecast is a 6% growth rate, which then should still bow, to come back to the equity question, should be okay in terms of an environment where companies can generate earnings. Because you must remember that the equity market only gets returns from two areas. On the one hand, it is what they can produce in terms of earnings, in other words, the economic performance, and then what are people prepared to pay for those earnings? And that is what we call the rating, or the price earnings multiple, or the price to book multiple. Forget about the jargon. You know, would they be prepared to pay up or pay less for that earning stream? And if they can still continue to produce the earnings, then I think there's probably less rating risk. In other words, people will still feel confident or comfortable. However, those ratings or the sentiment is very bullish or very positive at the moment. And should you get a negative surprise on interest rates, or in other words, interest rates go up higher than what the market expected, then it will be bad for equity performance. There's no doubt about it. But the base case for us is that we will not necessarily see in the next 6 to 12 months a negative surprise on the interest rates front. And therefore, you know, I think you can probably expect a more controlled de-rating in the market with pretty decent earnings numbers coming from the market. But, you know, so for me, that is important. But what would be more important for me is just your starting point, Mark. And that for me is the big risk. The starting point is that equity valuations in general, but particularly on the growth front, are quite high, and you can't expect a re-rating from these kind of levels. So the returns that the equities will have to generate must come from the earnings side rather than from a re-rating side. So, you know, the markets have done exceptionally well last year, and this year, if you look at the US markets, up by about 17% year to date. We would be very happy if the US market can give us somewhere between 5 and 10% over the next 12 months.
Thanks, Alvin. So the trends that we've got so far is we've spoken about inflation, potential money policy tightening, monetary policy tightening. The third one that we spoke about before our call was you mentioned at the end of a multi-decade bond market, Alvin. How do you see that materializing in 2022?
Yes, you know, quite often as investors, we think 5 years is a long time, but quite often they are multi-decade events. And what we've seen, and Phil spoke about the inflation of the mid-70s when we had double-digit inflation, and for anybody with an African connotation, double-digit can mean anything from 10 to 100% inflation. So there is a wide range. But what happened in the States was we had 10-year long bond yields trading at about 15% or so. That has come all the way down when you take it to the beginning of this year, when 10-year bond yields in the US traded at 0.9%. So you only got, which means that if you buy a bond and you hold it for the full 10 years, your return that is guaranteed is a 0.9% return. Now think about Phil's view that, you know, inflation now sits at 5.4. Let's say it comes down to 4%. That means that you are guaranteed to earn a negative return in real terms for bonds. So our view is that given the higher inflation, the market can't ignore that, and that long bond yields can't forever trade at these big negative real terms, in other words, way below the inflation rate. Of course, it's artificially kept there by, as Phil mentioned again, by the central bank authorities that are simply creating money by buying these instruments. And we know that they're going to buy less. That should put upward pressure with the higher inflation on those yields. So despite the fact that that asset class is uncorrelated to equities, and that is why people might hold it in portfolios, the investment return prospects for that particular asset class, given the low yields and given the fact that we think it's the end of this multi-decade bull market, I think the investment return prospect for that market looks very, very muted to us.
Well, anything you want to add? Alvin, I wonder if you could just stop your screen share as well there, if you don't mind. Thank you. Phil, anything you want to add to that point from Alvin before we move on to our first question?
Yeah, I would say the bond market is a very varied market. So there are more instruments in there than purely government bonds. I wholeheartedly agree. If you lend money to the US government or to many of the developed economy governments at less than the rate of inflation, and you lock that in for a 10-year period, the outcome is not going to be very good. You're not going to make any real profits. You're going to lose purchasing power. However, you don't have to lend for 10, 15 years. You can lend for shorter time periods. And that gives you a lot of flexibility. And don't forget, bonds, they're self-liquidating. So you pay you back and you get the money back. So if you lend for 2 years, 3 years, then you only have to wait a couple of years, then you can get your money back and you can reassess the situation, and there might be other opportunities out there. And additionally, corporate credit is still, you can get twice the return. Sometimes you can get nearly 4% return depending on which markets you're in. So there you can at least have a chance at matching inflation. So bonds, they still are a lower risk asset. They still have a place in people's portfolios. Just don't buy the 30-year bond. It would be the way we look at it. You had a huge chance to sell out of government bonds last year when the US was trading about 0.5%, pittance really, and they've moved up to 1.6. I think they could probably move more. So we would expect those yields to drift higher a little bit, but don't get carried away. Don't think that yields are going to go to 3.5%, 4%, because the reality is there's a lot of arrogance that politicians and central bankers have, and they fully believe that they can control the system and that deficits don't matter and they can spend their way out of any problem. So as those yields start to go up, and especially if it starts hurting the economy in their view, what they will start to do is they will intervene more, not less. And they will start to do things like yield curve control, where they deliberately target sections of the yield curve that they are unhappy with, where the yields are too high. And that will put some sort of a cap on those yields. Of course, the converse to that, or the consequence of that, is that means that inflation is unlikely to come back down, which is why we think that we're in an environment where inflation is just going to be higher for longer. So multi-years of, think about inflation being 4% to 8%, over the medium term, the next 5 years, let's say.
Fair enough. As you say, we could probably speak on this point all day, but I want to move along and to matters more immediate. We saw yesterday and the day before that, Bitcoin reaching new heights. Alvin, Phil, at what point would you start looking at crypto as an asset class, if ever?
Look, no, the true answer is, as I explained to you yesterday as well, that it is very hard to put a value on a cryptocurrency. The way we put a value on any asset where we can is the asset must produce an income stream, and when then we discount or calculate a value on that future income stream, and that is the intrinsic value of the particular asset that we hold. And in the case of a cryptocurrency, it doesn't produce any income, so it's very hard to put a value on it. So in the language of Warren Buffett, so when you buy cryptocurrency, it simply means that you are waiting for somebody else, and I think Buffett uses the word another fool to pay more than you hope for another fool to pay more for the particular asset, if you can call it an asset, than what you paid for it. And as long as the price goes up, there will be enough speculators that will do that. So that is the one part of it. The other part is you can't ignore the fact that I think there's 2.4 trillion US dollars invested in the asset class. So it is gaining popularity. So what we've done on our side is we have engaged internally with people who understand those currencies better than us, and we've engaged with a UK firm who focuses on it to do the homework for us, and then we will decide whether we can, as a private client investment company, whether we can offer that for clients. And remember, there are many cryptocurrencies. So, and there are things that, like arbitrage, that you can do that has got nothing to do with the currency. There are arbitrage opportunities that you can utilize as well. But for us, it is not a currency, because you don't have a claim on somebody else who issue that. It's very difficult to fundamentally calculate the valuation, and therefore you guess on valuation. And that is why we haven't included, but we are doing our homework. And for those who have the appetite, you can maybe include a very small portion of their portfolio in that. We will offer that, but it is not something that sits with our investment philosophy and sits with our view that, you know, investment is not about guessing. It is about taking the uncertainty out of it. And there's so many uncertainties here that we can't offer it as part of a normal private client or even institutional portfolio at the moment.
Thanks, Wolfgang. Just looking at the mindful of time, and then we've got a number of questions we want to deal with. I wanted to touch on a further issue with you, Phil. I wonder if you can give us your views on the Chinese crackdown. Is that going to be carried forward into next year? Is it going to be more of the same? And has the regulatory crackdown related news been priced into Chinese markets, or is there more downside risk not priced in from your perspective?
Yeah, I think the current wave of regulatory action has subsided a little bit, and probably is mostly priced in at this point. So we are starting to see quite a few of those shares and companies start to recover in the stock market as investors' appetite comes back. But I would say the investment community generally has been a little bit wrong-footed by this, and I put us in this camp as well. To some degree, we were seduced by, you know, the very attractive nature of some of these incredibly strong companies that are doing amazing things. You know, they have unique market positions. Some of that is sort of granted, a monopoly granted by the state, with competition restricted. So fair enough, but still, you know, they have done very amazing things, and the growth rates have been, you know, truly astounding. So that attractiveness of, you know, accessing the world's second biggest economy with some of these fantastic companies, and of course that is going to bring people in. And I think we probably did, you know, forget a little bit about, you know, it's not the same legal structure as Western democracies. It is a communist system. It is ruled ultimately by one person whose tenure could last quite a long time. And, you know, if they decide that they want to, you know, change the regulation and tighten that up, they obviously, it's within their rights to do so, and that can happen very quickly. Now, I think a lot of that, as I said at the start, has passed and subsided. So the actions that they've taken, they seem to have at least got to a place where they're happier with. But I do think there's more going on there than possibly we understand. And I think about the amount of the economy that is devoted to construction and building houses and building office blocks. It's about, you know, 28% or so of the economy that is, you know, just building stuff. And then a lot of the times those buildings have just stayed empty, or the ghost cities that we've talked about in the past. And recently, some of them actually been demolished. So if you build something up and then you demolish it, ironically, it all contributes to your GDP. Whether it's useful to anyone in society, I guess, is another question. But with such a large amount of the economy devoted to an activity which is now questionable, you have to then think, are there deeper problems in the country? And as they try and evolve away from producing, you know, buildings that people don't need to building goods and services that people actually want to buy, that transition can be difficult without a market-based economy. That you need the market and prices to tell people, I want this, I want that, produce this, produce that. If you do it at a top-down level and you try and anticipate what the people will want and then produce that for them, you oftentimes get that wrong. And I think China is struggling a little bit with that at the moment. And unfortunately, they've stepped away from a market economy rather than closer to it. So they've got more regulation and more government help, should we call it. So whilst the crackdown, I think, has ended on China, I don't think we've seen the end of maybe issues that might come from the region and a knock-on effect to the global economy. I mean, iron ore is the one that comes to mind the most clearly. How much iron ore do we need if we're not going to be building as much stuff in China? The opposite to that is copper. We probably need a lot more copper because we're trying to move to a green economy. So there's a lot of things that change, I think, with what's happening in China. We just don't really understand the full extent to it.
Certainly the copper price will please our attendees from Zambia. Alwyn, China has also faced electricity constraint issues. And we've seen a number of industries already cutting back on their manufacturing time. If that persists, where do you think that's going to affect emerging markets such as sub-Saharan Africa, which essentially has been China's quarry?
No, that is dead right. So the logical conclusion would be if there's less demand coming out of China, it will have a negative impact on Africa and those countries and companies that would produce the metals and minerals that China would use in their production processes. So, you can't get away from that. But I think what has happened in Africa, and by the way, in the commodity producing world, which would probably include South America and Australia, is that producers have responded in an exceptionally rational way when the cycle went up. What you normally see when commodity prices go up, what would miners do? They just take the money that they generate and they dig more holes. So they generate more metals, and ultimately it weighs down on the commodity prices. What has happened this time around, it is very clear that mining companies actually said, we want to protect our balance sheet and we want to focus on the return of the investment. So we're not going to chase market share. So when we have these increased demands that Phil spoke about, what we've seen is because the supply of metals didn't really come in abundance, the commodity prices went up. Even dirty commodities, if I may call it that, even those prices went up. And the reason why we have gas shortages and oil shortages is because oil companies didn't explore, because they didn't make the money. And what you're seeing now is an exact, to my mind, a result of very irrational behavior from producers where they said, we're going to focus on capital, returns on capital, rather than just chasing the market. So the demand side will have an impact, but I don't think it would be as bad as on a normal cyclical circumstances where you had decline in demand plus a huge supply impetus and then a decline in the commodity prices. So I'm certainly not as bearish, and I think some of it is also temporary. So it will be disruptive now. And by the way, it's not only in China, it's in other places in the world as well. But we are not that negative on the cycle. And then the two of you just mentioned copper, the other one is nickel. Go and check the nickel price. Both those commodities, as you move to a greener society, there will be demand for different commodities. And in Africa, we produce those other commodities as well, as you mentioned. So I don't think it's doom and gloom when you move more greener. It will be a bit disruptive, but we remain quite optimistic in terms of some of these commodity producers. And this time around, and I hate to say that, it seems to me it's a bit different because it's never different, but it's this time around, it seems to me it is a bit different because the commodity producers, I thought, responded in a very rational way in this cycle.
I mean, one thing I would just add is, clearly the world has told the oil and gas companies very clearly, we don't want you to expand production. and investors are also telling oil and gas companies, we want you to move towards transition towards a greener economy. Even if they earn really high profits now because the oil price is high, that doesn't necessarily mean that it would still be a good investment, because it puts on the table, I'm a government, I'm short of money, who can I tax? Oh, there's nasty oil and gas people. So windfall taxes, to my mind, become a very acceptable political choice for cash-strapped governments, as we've been talking about. So just because the oil price is high, don't necessarily rush in to buy those oil producers, because they might get their profits taxed away. Just as China taxed some of their companies, the same could happen elsewhere.
A topic for next meeting, Mark, is how the world will handle this energy crisis in a green environment, because this is the first energy crisis in a green environment. And it would be very interesting to see how green they will be if it really becomes a crisis and the Brits can't fill up their cars in London.
Well, I'll make a note of that, Alvin. We'll happily have you and Phil back again. I want you to move on, and we've just got a few minutes left. Alvin, value versus growth. There's been research articles recently that the turn of value as opposed to growth is coming. We know that growth has trumped value since 2007, I think it goes back. Have you got a view on that? Where do you think that trend is going to end up?
Yes, we always have views on things. It doesn't mean to say that they're always right, though. This might be a bit of a technical slide, but it is, for me, it's one of the crucial questions in investment managers, although Warren Buffett would say that growth and value, they are linked by the hip. But traditionally, people, growth style and the value style were probably on the opposite side of the spectrums. But nevertheless, if you look at this, all of this tells you is the MSCI, they've got a world growth index. So those will be the go-go companies. And the biggest component in the growth index will be information technology shares. I think it's about 30% of that index. And then opposed to value companies, those are companies that trade on a low PE or low price to book. And the big difference between the two indices from a sector specific is information technology. And on the value side, there's a lot of financials, banks in particular, and a lot of commodity shares. And you can see that the value outperformed growth since the 70s, and from 2007 until today, growth companies outperformed value companies by 100%. And if you look at the actual numbers on the right-hand side, growth companies on average generated a return of 10% per annum, where value companies over this period, 14-year period, and value companies 5% per annum. So if you're a contrarian person and more value orientated, you will immediately say, well, I think this thing looked topish, and this thing should turn around. But the world doesn't work like that always. There are more nuances to it. But nevertheless, I think, if we can continue to see decent economic growth, what is likely to happen is that the value companies that we spoke about, the banks and commodities, for instance, that they will benefit from this growth environment, and that the earnings is then are likely to surprise on the upside. And that valuation gap, and hopefully that is the next slide, the valuation gap, you can see that growth companies now trades on this slide on a price earnings multiple of about 27 times. Value companies in this slide at the moment trades at a valuation of about 13 times. So from a price earnings perspective, growth companies are trading at double the price of value companies. And if you get a positive surprise on the growth side, we think that this slide that I've just shown, that this slide is likely to move towards this. It looks quite topish now, it's likely to move in this direction. Doesn't mean to say that you shouldn't hold any growth companies. It doesn't make for a good portfolio to exclude them completely, but it does mean that if your focus was on growth here, over this period, we would suggest that from a portfolio management perspective, that more emphasis should be put on the value side, and that is where you should look to find the heavier fish or the shares that will outperform over the next investment cycle.
Thanks, Alban. I wonder if you can just unshare your screen, please, or stop share. Thank you. Phil, I know that you've got a comment on that as well, but I wanted to move ahead because we've got literally 2 minutes left. And I've tried to touch on as many of the questions as we could during the session. Currencies for next year, since we are talking about trends, if you gaze into your crystal ball, where do you think hard currencies and EMs are going to end up? I wonder if I could ask you to look at the sterling, euro, and the dollar, and then Alban, on emerging markets versus those hard currencies. What do you expect?
Yeah, currencies are always a little bit tricky. It's hard to forecast them. If anything, trends that are in place tend to stay in place, is what does seem to work. But we look at purchasing power parity. So when you adjust for inflation, what does the currency purchase? Is it getting more valuable or less valuable? And on that basis, nothing really stands out as too exceptional. Things are sort of fairly middle of the road. But the big one for me, and it's not a new thought, is just the US dollar and the potential for that to weaken and depreciate quite significantly. I think that is still out there. The trade deficits they have, the reality is the world is making a load of stuff and we're shipping it over to Americans on a kind of fire sale basis. And that's now been brought to a point where the whole system is creaking and struggling to do that. We can't get ships because they're all going to America and then coming back empty. And the world just needs to, or the world is likely to turn around at some point and say, especially when we move through next year and that inflation is still there and the monetary policy response is more muted than people expect, there's potential for real weakness in the dollar and maybe a bit of a reset, sort of a 40% depreciation.
That's a significant call. Phil, 40% over how long do you think?
Yeah, I mean, don't look at it as a call. Look at it as a risk that's out there, as something that's very, very possible. And then think about your portfolio and how would your portfolio hold up in that view? And if it does very poorly, then if that happens, don't get upset, right? Because it's a real possibility. What's the other side? Is the US dollar going to appreciate by 40%? No, I think you're less worried about that. So, when you're putting your portfolio together, just have a bit more geographical diversification. Right? The US market in the MSCI is about 70% of the basket now. Does it make sense to put 70% of your capital into one region, especially when 2/3 or more of GDP is driven by the consumer? And that's where the unsustainable part of it is. So I just think, do the sensible thing, diversify, think about what would happen in a world where the dollar just loses some purchasing power and how would you protect yourself and how would you diversify your savings? Your capital is precious. So think twice before you do something with it.
Alban, any comment on what Phil has said, and then what do you think emerging markets are going to do versus hard currencies, including the dollar?
I must say, I think I understand what Phil is saying. He says, I know where the balance of probabilities lie. And for him, the balance of probabilities lie for a weaker dollar. And if that is the case, if that is hopefully my English is correct here, if that is your denominator, so if you measure emerging markets against a currency that you reckon can weaken, generally, then emerging market currencies should, all things being equal, behave. We pay a lot of attention to the rand, which is an African currency, and it is very true. I mean, we've tested it, that there is a correlation between the inflation rate differential of South Africa and the rest of the world. So the purchasing power parity theory in simple English works for the rand. And at the moment, the rand is fairly valued against the dollar. But if you think that the inflation rate differential will come in other words, the difference between inflation in the US and South Africa, and then maybe for other African countries as well, if that gap is going to, that gap is going to close, then the natural depreciation rate should not necessarily come through in future. So, we are not that negative. The value that we put on the rand, by the way, is around about 14.20, 14.20. So the rand is more or less correctly valued at the moment. And all the currencies, so the Namibian dollar would be correctly valued. Just remember one thing, that in the emerging market world, there are always, accidents are always more common than in the developed world, but nevertheless, all things being equal, we think that the market is actually quite rational when it comes to emerging market currencies at the moment. And if you can track the rand versus the Turkish lira versus the Russian ruble, you can do it against South American currencies, the real of Brazil. They all trade in exactly the same basket. The credit ratings are more or less the same. So if we are quite sanguine about the rand, then we probably should be sanguine about other emerging market currencies as well.
I mean, just maybe on how it pans out, think about it. Have that inflation differential. So higher inflation for longer, especially in the US. Okay, so if you're at 7% this year, maybe 6-7% next year, right? You've already got sort of an inbuilt 15% depreciation there. If the dollar started to fall, well, what happens? Well, all of those things that Americans are importing would go up in price. It would put more upwards pressure on the inflation. So you get this vicious circle that starts to embed itself. That is the risk that the US has put itself into, the vulnerabilities of a trade deficit and a government deficit. So any weakness in the US would put upwards pressure on inflation and cause potentially more weakness in the US, which is why I say you could have a larger outside move than people might expect.
I'm reluctant to end it there because it's getting quite interesting. But I think we've touched on a lot of the questions that have come through. I'm mindful of time. Alvan, Phil, it's been a pleasure, and we'll welcome you back. Alvan's already given us some suggested topics which we'll definitely explore. So we look forward to having you back. Thank you to everyone for joining us this morning. The recording will be available on YouTube, on our YouTube channel in due course. Phil, Alvan, thanks very much for your time, and thank you very much everyone for attending from me here in Mauritius. Have a good day. Cheers, everyone.